Hi, my name is Karthik Rangappa. In this video, we will understand the payoff structure of a call option, both from the buyer and the seller's perspective. In the previous video, we posted few questions about the profitability of a call option buyer. The questions were around the break-even point, what is the worst case situation that is likely to happen, and what is the maximum profit potential that the call option buyer has. We bought the call option of SBI at 17 rupee 50 paisa. The strike price was 460. Let's try and get the answers for all these questions that we posted earlier. Now that I've bought the 460 call option of SBI Bank, what do you think is likely to happen by expiry? Well, there are only three possible outcomes here. 1. The stock price of SBI rallies. 2. The stock price of SBI remains flat at 460. 3. The stock price of SBI declines. Let's try and understand what happens in each of these cases. Assume the stock price goes to 500. What do you think is the profit or loss here? Clearly, this is a profit-making situation because the stock price has gone to 500. I, as a call option buyer, will get to buy SBI at 460 when the stock is trading at 500. Now, what do you think is my profit or loss in this case? Well, this is clearly a profit-making situation. I get to buy a stock worth 500 at only 460. That means to say I make 40 rupees here as profit. But of course, I've paid 17 rupee 50 paisa as a premium. Therefore, I need to adjust for it. After adjusting for the premium that I've paid, the net profit that I make here is 22 rupees 50 paisa. Now, it's very important for you to remember that this profit number that I'm talking about right now is keeping expiry in perspective. We will talk more about that later. But for now, I just want you to understand that the profit that I make in this situation after adjusting for my premium paid is 22 rupee 50 paisa. Now, let's look at the second scenario. Assume that the stock price remains flat at 460 on expiry. What do you think will happen here? Do I make a profit or do I make a loss? Clearly, there is no point me exercising my right to buy the option here. Therefore, I let go of my right, which also means to say that I lose the premium that I've paid. So the worst case situation here is that I lose the premium paid, that is 17 rupee 50 paisa. The third outcome here is that the price of SBI actually drops. Let's assume it drops to 360. What do you think is likely to happen? Well, clearly there is no point in me exercising my right to buy SBI at 460 when I can actually buy the stock at a much lower price in the open market. Therefore, I'll forfeit my right to buy the option, which further implies that the premium that I've paid will just get flushed down the drain. So again, the loss is 17 rupee 50 paisa. So from a call option buyer's perspective, we can generalize three things here. As a call option buyer, I will make money only if the stock price increases with respect to my strike price. If the stock remains flat or if the stock declines, then there is no way I will make money. I will lose all the premium that I've paid. Therefore, you buy a call option only if you're bullish about the prospects of the stock. But the twist here is you need to be bullish, keeping expiry in perspective. That means to say you need to define the time period, and within that time period, you need to identify yourself as being bullish or bearish on the stock. If you're bullish, you can look at buying a call option. Now, here's the thing. To explain this concept, I just took three different price points. But in reality, the stock price of SBI can be anywhere by end October. It can be as high as 1000 or it can be as low as 200. You'll never know. Now, the question that I want to ask you is, what do you think is your profitability? Let's say if SBI goes to 650. Now, there is an easy way to identify your profitability given the stock price at expiry. To help you understand this, I have put various possible outcomes on Excel. Let's quickly evaluate that sheet for further understanding. I've got all the basic details on Excel here. The option type is a call option. The position that we are looking at is buy position. Remember, we are evaluating this from a buyer's perspective. The strike price is 460. The premium that we've paid is 17 rupee 50 paisa. The expiry is 30 days from now. Now I've got three different columns here. The first column is the possible stock price upon expiry. Remember, it can be anything. I've represented a range here from 285, as low as 285, up to 652 rupees. This next column represents the premium paid. Remember, the premium that you paid today will remain the same throughout expiry. Therefore, that is fixed at 17 rupees 50 paisa. There's a negative sign there which indicates that it is cash outflow from your end. You're paying that money. Therefore, it is a negative 17 rupee 50 paisa. The third column represents the profit or loss based on the possible stock price upon expiry. Now recollect, when we generalized, we said as long as the stock price remains flat or declines, all you lose is the premium that you've paid. Now that's exactly what you see here. 460 is the strike. 460 or any price lower to 460, your P&L will remain flat at 17 rupee 50 paisa. Whereas, as the stock price starts to increase, you will start making money on a call option. Now, if you plot a chart of this, you will end up getting something called as the long call payoff, or simply the payoff of a call option buyer. Let's plot a chart and see how that looks. Now, here is how the chart looks. Now, this is a very interesting chart. What it is trying to tell you is that your loss, irrespective of what happens, is restricted to 17.5. Now, there is a point here where the blue line meets the gray line, and this is the zero line, and this is the 0 point, which means to say at this particular point, you break even. You neither make money or lose money. Now, if you look at the table on the left, you can identify that 477.5 is where you break even. How did you arrive at 477.5? Well, it's straightforward. It is the strike price, which is 460 plus the premium that you've paid, that is 17.5. So 477.5 is where you break even here. Anything more than 477.5, you start making a profit. As and when the stock price increases, the profit potential increases. This is called the payoff of a long call option, or simply the call option buyer. Now remember, when I bought the call option of SBI 460 strike by paying a premium of 17 rupee 50 paisa, there was a seller on the other side of the market. Now the question is, what is the P&L profile of this option seller? Well, to develop the P&L profile of an option seller, all you need to do is invert this graph. Now this is a very interesting graph. What the graph tells me is that the maximum profit potential for the seller here is 17 rupee 50 paisa. Remember, that was the maximum loss for me as a buyer. Now that becomes the maximum profit for a seller. Again, the break-even points for both buyer and the seller remains the same. That doesn't change. But now here's the most crucial bit. As and when the stock price goes up, I as a buyer will make money. As and when the stock price goes up, the seller will start losing money. Therefore, the call option seller's payoff is a mirror image of the call option buyer's payoff. I hope you are now comfortable with the call option, both from the buyer and the seller's perspective. It's fairly simple to understand. If you recollect, we discussed there are two types of options, call option and put option. Right now, we've just discussed the call option from the buyer and the seller's perspective. In the next video, let's discuss the put option. Key takeaways from this video are: